Cody Mackey, everybody. Take it over, Cody.
Absolutely. And as Jimbo said, anybody joining the lounge this morning got a little sneak peek of my presentation today. So let me ask you guys. I know we have a lot of students out there that are getting started off, a little bit smaller accounts. What if you could control more with less money? Would you like that? I already know a bunch of yeses are going to come in because one in everyone. So Noah just set up the trade on Sony. So one thing that I'm going to show you real quickly is what the risk graph looks like on a simple buy order for Sony. It looks very simple. If the price of the stock changes, your profit goes up. If the price changes against you, it goes down. Now, in order to get in this trade on margin, you have to put up $4,000. What if you only had to put up about a tenth of that? What if you only had to put up a fifth of that? That sounds like a pretty nice deal for me. Now, sounds a little bit too good to be true. Well, it kind of is because there's a few other factors that we need to worry about. So what I'm talking about, of course, are options. In the options market, there are what are known as call options and put options. And an option is simply a contract between two traders on an underlying asset. So I'm going to pull up a PowerPoint from little sneak peeks to the Options 101 course. For anyone that's actually taken that course, you might recognize a few of these. But when you look back at options, there are a few key terms that you got to worry about. You have your strike. So the strike price is the price at which a buyer has the right to purchase the underlying asset. So in an options contract, everything has a strike price based on the stock price. You have the expiration. Every type of contract has an expiration date, whether it's an option to buy a house. If anyone's sold their house recently, you know that signed contract to buy a house has a time expiration. By X date, the buyer will purchase that house for said amount. There's a time limit on it. The underlying asset, so in that example, that would be the house. In the stock market, it's the stock itself. Next, you have the multiplier. So in this example, we're going to be using pizzas. As I said, I stole this from a Options 101 course that was created by the amazing Tyler Craig. So if you haven't seen that one, you definitely need to go over there and take that course. Is how many pizzas or assets do you get to buy based on one contract? And last is the premium, the cost of the actual asset itself, or not the asset, the cost of the contract itself. So really quickly, a metaphor I really love to use when I explain what a simple call contract is let's say you own a house, right? And you own this house and it's sitting at the edge of the woods. And you and I go into contract saying that I'm going to buy your house from you for $100,000. Let's use some easy numbers. And we agree to this contract, and I put some money into escrow and I put that down. That gives me the right to buy the house from you for $100,000 in the next 30 days. Well, what if a week after we sign that contract, the city comes in and says, hey, all those woods next to you, we're going to tear that down and build a golf course. That house is about to appreciate in value pretty rapidly, right? Wouldn't the seller of the house love to pay me more than I paid to sign the contract to rip that thing to shreds? They would absolutely love to tear that contract up. Well, that's one of the things that happens with call options, is as the price of the underlying asset, so in this example, the house goes up, the price of the contract goes up. When the price of the stock for an underlying call option goes up, the price of the call option goes up. Now, let's say the reverse happens. What if the city says that we're going to tear down that forest next to your house, and instead we're going to put a landfill? Now, the price of that house is going to decrease in value, meaning that contract itself is going to decrease in value. I would do anything to rip that contract up. So the price of the contract itself is changing in value relative to the main asset. So let's take the Sony example again. Okay. Actually, let me go back to the PowerPoint for a little bit. Let's look at, why does it keep doing this? I apologize for that, guys. All righty. So you have the buyer. So in this example, or the example I used was a house, but in this example, we're going to use a pizza. So pizza restaurant's open and they sell pizzas at their normal price of, let's say, $10. Prices are going up now. That's inflation in the market. But the buyer has the rights to buy that particular pizza based on the organization. They have the rights to buy the pizza from the pizza parlor. But what if the Fat Tyler, Domino's Pizza. All right, so the underlying asset is the pizza itself. The price of the pizza is $15. The strike price of that pizza is going to be $5. So what if there's a way that I could buy the pizza for $5? Well, how long does that coupon, which is the way that pizza parlors actually build these type of contracts with their pizza restaurant, is that they offer coupons. You get a coupon that says you get the right to buy a pizza at a certain price for a certain amount of time. Every coupon has that expiration date. So you have the premium itself, so whatever you have to pay for the coupon, and then you have the multiplier. How many pizzas do you get? How many medium-sized one-topping pizzas can you get for $5? You have to pay a little bit more for that. They say you can get 3 one-topping medium pizzas for $11 when the actual cost is $15. That's a really good deal. That's a good way to be able to multiply your money. So when you're looking through this, you always have the contract itself, which would be the buyer. So in this example, Tyler. Tyler has the right to buy 1 large pizza for $5 for the next year. That's a long coupon. But as that coupon goes on, it starts to lose its value. All right, what about the pizza prices itself? As the price of the pizza were to go up in its original value, the coupon becomes more valuable to the holder of the coupon. So as the price of the pizza goes up, the price of the coupon's value goes up as well. However, there's that time expiration. The closer it gets to expiring, one day that coupon is going to be worthless. If it's never used, that coupon is worth 0. That's what's known in the market as your theta decay. So Tyler has the right to buy 1 large pizza for $5 over the next year, or maybe over the next month, depending on the expiration date of that coupon is what happens. Now, volatility in the example is the difference between using a coupon to buy a 1-topping pizza, or maybe you're buying a full-on Supreme. Some of them are a little bit more valuable than others. So let's see how this works within the actual stock market. So if you want to buy Sony right now, you have to put up $4,000 in order to buy 100 shares of Sony. When you're looking at options contracts, so what we're going to do is we're going to have a few rules in our options contracts. One is if we are going to be buyers of options. Today, I'm just going to teach you how to swing trade using options, meaning that we are going to be the buyers of the option contracts. So I'm going to teach you some of the negative effects of being the owner of the contract. And then later on, when we get into the call, the coaches will teach you some of the positive effects of being the seller of the contract. So right now, I'm just teaching you the negative effects of being the owner of a contract. So one of the things that we're going to do to make sure that we are looking out for this is we're going to go 65 or 60 days plus out in value to look at a contract. So right here on Sony, I have to go to the 128 because that's further. I can go to 165, but that only gives me 5 days to play with before it's now violating the rules. So if you're out there and it's the first time you've dealt with some of the call options, write that down. You want your contracts that you're buying to be 60 plus days out. So we're going to go out to December, and we're going to say, rather than buying 100 shares of Sony, instead, we're going to buy 1 call option of Sony. Now, what this call option does is it gives the owner, me, the right, but not the obligation to buy 100 shares of Sony in the next 128 days. Now, what does that mean when it comes to the risk graph? So let me turn off the 100 shares. So now, versus having to put up $4,000 to put on this trade of 100 shares, I'm only needing to spend the $490 times 100, so $490 to get into this contract. So you can see here we have 2 lines. We have the blue line and we have the pink line. The blue line is what the contract will be worth at expiration. This contract, if it does not move in price at all in the next 128 days, then it's going to be a loss of $490. That $490 is what I spent to buy the contract. However, that $490 gives me the right to buy Sony at the strike price. So the strike price that I just purchased was the price of the underlying asset, so the price of Sony stock itself at $82.50. So at $82.50, over that time frame, the next 128 days, I can at any time buy 100 shares of Sony stock at $82.50. So over the next 3 months, 4 months, till we get to December, if Sony were to continue in its upward trajectory that we're seeing, and let's say it gets all the way up to $100 over the next 6 months, right? Because not 6 months, till December, 4 months. So till December, way out here. If it gets all the way up to $100, how many of you would love to be able to buy this back down at $82.50? I know I would. It's at $100 stock. I would love to always buy something at a lower price than it currently is. So in doing so, I have two options. One, I can execute the contract and actually purchase the 100 shares at a cheaper price. Next thing I could do is I can just sell the contract back to the seller. So the same thing as the house metaphor. Golf course is being built, that house is going up in value, and they want to pay me to rip that contract up. So I can either purchase the house or the stock at the cheaper price that's agreed upon in the contract, or I can let the seller of the contract pay me a higher price to rip it up, be done with it. So what if I take the option to just have him rip it up? So let's say it goes all the way up to $100 within the next 3 months. Now my profit, so let's look at the stock. To hold the Sony share from $82.50 all the way up to $100, you can make $1,900, but you have to put up $4,000, meaning that your return on investment on that trade, your return on investment on that trade, a little less than 50%, $47.50. All right, that's a good trade. Absolutely good trade. Made 50% on your money. Good trade. But if I do the option itself and I put up $490, what I used on the contract, and then it still moves to $100, well, now I make $1,356. So what does that look like? If I'm making $1,356 divided by the $490 I had to put up on the contract, my return on investment is 270%. Doesn't take a math genius to know that 276% is larger than 50%, 47.5%. However, I told you there was a risk in there that you got to think about. So let's talk about that. What's that risk? That risk is what we know in the market as theta. Theta is time decay. The closer this contract gets to expiring worthless, the closer. What is the strategy called? This is simply a long call. Simple strategy. You are buying one call option to own the rights, but not the obligation, to purchase 100 shares of Sony. This is a long call. So the downside is that theta known as time decay. So on Thinkorswim, one of the coolest things about the risk graph is they can show you what time decay does to your potential profits. And right here, you can see it's got this little chart. It says today's date. That is exactly what I would make if it jumped to $100 today. Odds of Sony jumping from $82.50 to $100 today, well, they're decreasing rapidly as the market closes in 24 minutes. So what we want to look at is the closer this gets to expiration, the closer the pink line is going to move to the blue line, meaning that the execution date is going to dictate the price, meaning that you are going to have to take ownership of those shares because the contract is going to either expire worthless or be executed. So if it gets to the end date in December, you have to buy the 100 shares or the contract is void. If you're selling it, that's a good thing. When you're buying it, you need to make sure you have that, or you need to close the contract before expiration. And watch what this pink line starts doing as I start increasing the date. As I increase the date, you can see that it's starting to move closer and closer to expiration. Let me jump out a little bit because I'm not going to click the full however many days there are between now and December. And as it gets closer, eventually the lines are going to equally match up until that pink line completely disappears, right there. So on the expiration date, 12/19, the pink line, also known as your extrinsic value, becomes 0. So when you're thinking about your call options, there are a few different factors. You have the right but not the obligation to buy or sell a stock. It allows you to leverage a smaller amount of money in order to play in the larger moves, but it also comes with that time decay facet asset that you have to worry about. If you are not trading within the 60 days plus afterwards, you end up with what is known as the rate of time decay. So I'm going to go back to the chart here, and I'm going to show you this page right here. So this is the decay curve. So the decay curve happens on every single option ever issued into the market. And you can see when looking at this that the rate of decay of the option starts to rapidly increase as you get closer to the actual expiration date. This is why we recommend that you always buy your options 60 days plus out, because those last months in that option are when the most rapid time decay is happening on your option. So what you don't want to do is this. So let me go back to Thinkorswim. And you say, all right, even $490, that's a little bit too much for me. What if I could just get it cheaper? Let me see if I can find something a little closer to my wheelhouse and not go as far out in date, right? And this is not what the trading system rules would say to do. But let's say that, like, all right, I'm just going to go out 37 days. And I'm going to buy a call at 37 days. Oh, well, now I only have to put up $200. That's half as much. Okay, yeah, that is half as much. But your theta that's working against you, that negative theta, is going to be draining money out of your account every single day. It's not fun to think that there's a slow drip out of your account. It's fun to think about a slow drip into your account. That's where our theta makers, that's where our Geno pours, that's where our theta queen comes in. That's where we want a slow drip into our account. We don't want slow drips out of our account. So let's see what that looks like if we were to buy a call option on 37 days out. Give me 1 second, guys. All right, and if we were to look at this here, we can see that as the decay goes down faster, that line's moving a lot quicker than it was 128 days out. So in the short term, your time decay is going to decrease against you a lot more rapidly. So even though you're having to spend half as much to buy that $200 contract, it's going to decrease out of your account much more rapidly. If you were to actually execute this particular trade, so let's say we execute this one. Let's see if I can get a fill before the market closes so I can show you what, there we go, boom. All right, so on that contract, this has a negative 3.45% time decay. So roughly you are losing $350 per day every day that this contract is not working in your favor. So even if it starts moving up into your direction, on the contract itself, let me move back to today's date, the 12th. Even if it starts moving up in your direction in that we want it to, every single day that it takes to move in your direction, you're losing a little bit of profit. So if it takes 2 weeks to start moving in the direction you want, then when you first initially execute that call contract, and let's say you're targeting, no, I don't remember what your targets were, but I'm going to look at this real quick and say the targets are going to be 85 and 90. So when I'm looking at 85, if it were to happen today, then my profit I can make off of that is $220. That $220 is not what it's going to be, because how long is it going to take for it to get to that $85? Well, it's probably going to take a week or so. So as you start to count down that week, you realize that time decay is working against you. So if we go out a full week, let's go to the 19th, that you see that your profit's not $220. Your profit's only $160. When you buy call options, that time decay is always working against you. And the shorter the time frame, the shorter or the faster the time decay is going to take money out of your pocket. This is why we always recommend going longer out. Matt, are you there?
I am, Cody, I am.
Matt,
Yeah.
how would you like to add to longer options versus shorter options?
Well, I think it's a wonderful point you're making in terms of the decaying asset of time. And that's the one that really is, I mean, delta is obviously the number one concern when we're talking about, making money on an option versus losing money on an option. But when you're talking about the 5 variables of the value of an option, unlike a stock, i.e. price direction, you have delta, you have theta, vega, gamma, and rho. And out of all of them, delta is a probability analysis. Volatility, vega, is a probability analysis. Even gamma, a reflection of delta, being a probability analysis. The guarantee of those variables would be theta. And one of the bigger mistakes I see new traders make, and I believe we did talk about this on our webinar we did, I think it was a week ago Wednesday when we did the rookie webinar, was they get enticed by looking at that, oh, I only have to spend X amount of money, and that's why I'm going to buy 36 days or 14 days, or I'm only going to be in the trade 3 days, so why don't I buy a short-term option? Well, you have to take into concern how theta is going to impact the value of that option. We were talking about,
so Matt, would you want a credit card with a higher interest rate or a lower interest rate?
I would like a credit card with a lower interest rate.
Right. So even though you have a credit card that says, hey, we'll loan you way more, but we're going to charge you 40% interest. No, I'm not doing it.
Yeah, no, give me the more time frame, give me the, all that. But when you're looking at, say, let's see the option chain there on Sony for a second.
All right.
When you're looking at a 37-day contract on Sony, and let's just buy an at-the-money call option, right? So you're talking about buying the 80 strike price, the current stock price, 80.67, the delta is 55. You could spend about $310, trying to, meet the mid there, about $310. But you're decaying at about what, $3 a day or $4 a day, which means you're decaying at this point right around 1%, right? Well, as you get closer to the expiration, and this is what we need to think about, we need to think about it from a percentage decay and not a dollar figure decay. As you get closer to the expiration, well, that risk starts increasing even more. And so if you take a look at the 9-day option there on Sony. If you look at the 9-day option on Sony here, well, on the 9-day option on Sony, using that same 80 strike price, yeah, I can lower my cost down to about $165 per contract versus a $310 in contract. So I'm lowering the amount of money I'm putting into the trade, but you're also seeing $7 in decay against the lower rate, which is right around, what would that be? Right around, 4.5% decay. So and I'm just
it's a virtual account, so I can throw it in there real quick. It's twice as much.
It's even more than twice as much than decay. So you're spending less, but you're also losing more per daily decay by utilizing a short-term option. That's why for not just new traders, but veteran traders, even if you're only holding short term, you still want the leeway. You want the amount of time in the contract, because even if you expect to be in a trade 3 to 5 days, you can't pick the market's timing.
Absolutely.
You can't be like, oh, if this doesn't go straight up in the next 3 days, I'm out, right? That's not how the market
The number of times that I've done long calls, like let's say right here, great example. Sony is turning out to be a perfect example. Let's say you saw this doji candle right there on a nice pullback, and you see that doji candle and you say, man, let me scroll over a little bit. All right, doji candle right there. Nice pullback on Sony. That's great. And you decide to buy a call option. There's nothing in the market that says that it has to pop tomorrow. And you know what? It didn't. It hung out for an entire week after you got into that contract before
and Cody, if you're in that 9-day contract, even if you're proven right ultimately on the trade, you're going to lose money. See, the way decaying works, yeah, think about it like this. If I buy a 4-month option, I'm decaying at such a low dollar figure that it's not even noticeable. You're talking fractional decay at that point. It starts creeping higher and higher and higher up until you get to the point of, say, 2 months left in the contract and you're decaying at about, less than 1% with 2 months to go. With about a month to go in the contract, you start decaying at about 1 to 1.5%. With about 2 weeks to go in the contract, you start decaying at 3 to 3.5, 4% a day. Up until the last day of expiration, when your pink line evaporated, Cody, think about it from a percentage decay. You're now decaying at 100% the rate of time. And so new traders, even though you can lower your costs, this is a pet peeve of mine when they're like, well, I only have to pay this. Well, you're only going to lose that then, right?
You're putting the odds against yourself is what you're doing.
You're taking a probability situation from a technical perspective, and you're making an unlikely outcome just based on the option you're choosing. You're
Absolutely
right on the analysis, you're right on the technicals, but you're cheap on the option. You're lowering your costs so dramatically in options. You don't need to go cheap when the options are already cheap. And so in my opinion, I think it's a little bit foolish to try to save a little bit of money when you're losing more money over time with theta. And mind you, I want you to think about one thing, guys. Where are those options when you're talking about cash flow condors, or when you're talking about, Mark selling naked puts, or when you're talking about, Greg's going to come on in about an hour from now and he's going to talk about covered calls? Where are all of those options where we sell them for cash flow from a time frame perspective? They're all in the last 30
We're
to 60
always
days.
selling 30 days. We want to be selling in 30 days. We want to be buying 60 plus days out.
Yeah, let the new traders who are not tackle trading buy those options from us all the time.
Let's stick to something that we know, and let's stick to one of the most consistent factors, like Matt said a second ago. With options, there are consistencies and inconsistencies when it comes to the stock market. The one consistency that is always constant is time. Regardless of where the direction of the stock goes, delta, regardless of what volatility does, vega, time is always a constant. It's always ticking at the exact same rate every single second, minute, day, week, year.
Yeah.
So as we have these time factors into it, so obviously there's no way that the market's going to give us the ability to trade 10 to 1 without them having some sort of benefit in their way. And they did that through saying, okay, you can have an options contract, but there's going to be a time decay to that. This contract is not going to last forever. So what we need to do as traders is we need to buy more time. By buying less time, that's exactly what they want us to do. That's exactly what the seller of the contract wants you to do. Yep. They want you to buy less time. I love selling 30-day options. I love selling 2-week options. If I can get a high spike in volatility, sell 2 weeks out, I love it.
I've seen it so many times in my career. Right on the analysis, wrong on the time frame. Right.
Exactly.
And this is not something new, guys. This goes back to John Maynard Keynes in 1920. Right on his analysis, went broke trying to be right in his time frame. Right. You see it over and over and over again. The economy's going to crash. The economy's going to crash. The economy's going to crash. And then all of a sudden, 4 years later, it finally crashes, but you went bankrupt before it ultimately ended up crashing. Right.
Oh, it does happen all the time. All the time.
All the time. It happens all the time. But
then after the market crashes, they say, hey, look, I was right. It's like, Yeah, how
Well,
much money?
yeah, but you're
How much
broke,
money did
so
you lose
nobody
along the
really
way?
is listening to you anymore. You're just complaining at that point. But the reality, Cody, is when you're talking about option trading and really to kind of go what you've been talking about so far, and thank you so much for doing this, is you're talking about two clauses in that contract. You have the time frame, which is theta, and you have the strike price, which is delta. And rule of thumb, we like to buy more time. If you
Yes,
expect to be in the trade a month, buy 3 months. If you expect to be in the trade a week, buy 2 months. Always buy more time than you think you know. And as a swing trader, especially if you're new, if you think about 90 days of time, if you're really working in that 90-day time frame, you're buying enough time for any swing trade to really work itself out. The second clause would be that, strike price clause, and that's really based on delta.
absolutely. So overall with options, so I'm going to give you guys a few rules out there. If you're looking to take advantage of the benefit of using an option that allows you to 10x your money that you're trading with, there's a risk to that comes with it, and it's theta decay. So the rules that we teach our students is that we're going to buy 60 plus days out. So write these down. You're going to buy 60 plus days out. Like Matt said, if you plan on being in the trade 2 weeks, we're buying, 3 months out. You want to buy a larger delta. So your delta is your directional probability based on the stock price. So in your delta, on your options chain page, you can add delta to the top. And the way you do that is simply by going up here and you can say customize, and then you type in delta and you add it to the right and you get your delta. So I have delta added here already. You see the deltas right there. Delta can do a few different things when it comes to an options chain. It's both the percentage change of dollars on a dollar price move on the options price, and it's also the probability at which the option is going to expire in that range. So when you have options and people that are buying out of the money options because they have more or less probability behind them, but a greater potential profit, but they're trading that theta versus their delta. So when you do so, we recommend you buy a 0.6 delta. So we're buying an in the money options contract, 60 plus days out, 0.6 delta or more. You can go more if you want to. And we're going to use that for that short-term trade. That way we are protecting ourselves from the time decay that we're getting, that I just explained how it can just eat away at that contract. I like to buy 90 days out. And if I haven't already exited the trade or spread the trade out by the end of the 90 days, I'm just leaving it behind. I don't care because I want theta working for me, not against me. So we want to buy 0.6 deltas. We want a pattern that we like. So Sony was a great example given to us by Noah. And we want to enter and exit the option based on what the pattern is doing. Meaning that if we buy our 120 days out in this contract and it hits $85, we are exiting that trade. We are selling the contract, or we're taking profit or spreading out some fancier things that some of our more senior students understand. But for our newer students, is in trading, there's always an if-then reaction. So for an option, because you're deciding to take on the excess risk of time decay, we need to make sure we protect ourselves from that. We do that by buying more time. We then want to take advantage of the delta. So we're going to get a larger delta. But when the strike prices and the targets hit, we're going to exit the trade. Because if we have it hit our target and then we say, but what if it goes up higher? But what if it goes up higher? Well, every time it has to go up higher, it's going to take more time out. As that time goes by, you start losing more money. So you end up being stuck in certain options where you're noticing no matter what the stock's doing, even if it's up, you seem to be at the same price. And that's because that time decay is starting to work against you. So the rules that I would give you if you want to do a call option is make sure that you're buying time, you're at a good delta, you have a good chart set up, and you know the stock's price at which you plan on exiting your option. if you do those things, option trading is a lot more fun because you get that leverage in there, but it comes at risk. Everything in the market comes with risk. There's no guarantee in trading, but as long as you know how to mitigate and control that risk based on the time decay and how you're buying your option, you'll be just fine. Now, I want to go into some puts really quickly. I know that Emily's coming up next after me, and Emily, she is here. And she's going to teach you how to start managing your individual portfolio. So really quickly, I want to ask the audience, what stocks do y'all have out there that you're looking to short? You think they're going down. You are bearish on these trades. And I'm going to quickly show a shorting of the stock versus a buying of a put option on those really quickly. So someone give me a short that you have out there. Matt, Emily, Tim, any of y'all got a good short I could
I was going to say you could try to make Mark feel better by shorting Tesla and show him how to lose money buying put options.
All right, let's do this. Let's.
Me and Dennis are all over on the same page, but in all reality, Jonathan, Zoom's a high flyer, starting to show some reversal characteristics.
Zoom is so just like
that support level right there. I mean, you got to have a projection down to what, 200 by one. What would that be? I'm trying to read your charts here.
You could almost get all the way to 180.
You could go 220 by 200, I would say, in short term.
All right. So again, with the rules of buying options, we got to have a good chart pattern. We're not just blindly buying options because we have an emotion about the stock itself. So that's actually a good reason to stay away from Tesla. So let's say let's look at two examples. One, we're going to look at shorting Zoom stock outright. So if we wanted to short Zoom stock outright, 100 shares, we have to put up $35,000 to short Zoom. That's a lot of money to short Zoom. Now, if it happens to drop all the way to that 180 we were looking at, that's a profit of $5,682. But it took $3,500 to do that. So let's look at let's get our calculator out and look at our profit. So we want to do 5,700, and I'm rounding these numbers off just for easy math, divided by $35,000, 16% return on investment. Not bad. Not bad at all. What if we bought a call or a put option, excuse me? If we bought a put option, again, we're going to go plus 6 days out. So I'm going to go to November here, 100 days out, and I'm going to buy an at the money put option. So Zoom's still a little bit expensive, but now in order to get into this put trade, what did I do? Wrong way. It's going to cost me $2,900. So a lot less, a tenth, less than a tenth of the 35 needed to short it directly. Market just closed. Sorry about that, guys.
Don't apologize for the market closing. That's everybody's like, oh, finally.
Yeah, everybody probably heard that at the same time.
It's like, oh, okay, now I don't have to wait. Now it's like a breath of fresh air.
Cody, whenever the market bell rings, I'm like, that much more theta just decayed.
Yeah.
No, I actually agree with you there. I'm just like, yes. Oh, lock in that theta. I have a personal theta target that I just, every time I see my theta go up, I'm like, yes, I just made that much money today. Market close. I just made that much money today. Market close. But anyways, I digress. I want to finish this example real quick and pass it off to Emily. The $5,700 we could have made by putting up $35,000 gave us a 16% return on investment. Buying a put option more than 6 days out on Zoom, we can make roughly $3,000. So $3,000 when we have to put up the almost $3,000, $2,900. So now we're looking at a $3,000 profit on putting up $2,900. We're getting almost 103% return on investment. I like that a lot more than a 16% return on investment. Options give you leverage, but they always come with a risk, and the risk is time decay. As long as you understand how the time decay works and you protect yourself against it when you're a buyer of the option, then you can leverage and take advantage of the abilities that options give you. Old phrase that options give you options, but they come with a few of these factors in the market. The number one being time decay. So we want to make sure that we protect ourselves against that. If you want to buy shorter options out there, just know that you're signing up for a very high interest credit card, and the money is going to be eaten away from you day after day. Right now, what Mark was just joking about, market closed. A lot of theta traders were very happy because they just took in more money. And you have a lot of traders that are negative theta in their accounts that just lost a lot of money. So make sure that you understand how time decay works, so that when you're using this leverage, this benefit of options, we need to just tamp down the risk of the options so that we can take advantage of the overall benefits.